In today's video, I'm going to give you the best strategy to invest in the stock market right now during this bubble-like environment. So I'm going to be talking to two groups of people. So group number one, you want to invest some money. You naturally turn towards the stock markets. However, the markets are at record high levels. So do you FOMO in or do you wait for a pullback? If you FOMO in and you buy, with your luck, the market will crash in a matter of days, right? And if you wait for a pullback, with your luck, the market will keep shooting up and you're going to get left behind. So what do? And then we have group number two. You have a good amount of cash. So good for you. Congratulations. You've been enjoying 4% or 5% interest rates. So not bad if you want to have some money in cash anyways, like an emergency fund, or if you just like having liquidity. But interest rates on cash and cash equivalents are falling and will continue to fall. So you know what's going to happen. You will have to move some of your money into equities because interest rates will fall to a point where the interest income is just not worth it. And you're going to be losing to inflation. Regardless of which group that you're in, the stock market is at a record high level. So here's what I would do. Don't take all your money and go all in. Dollar cost average in. Invest in intervals. So if you have cash already, choose the total amount that you want to deploy and choose your time frame and then deploy it systematically. So for example, if you want to invest $10,000 in total, then deploy $1,000 in the middle of the month and $1,000 at the end of the month. Do it if the market is up or down, regardless. So you're not trying to time the markets. Within 5 months, you'll have fully invested your money. Now, if you don't have any cash, then on every payday, just transfer some money into your brokerage account. I would recommend that you do an automatic transfer. If your budget doesn't allow for much, just do any small amounts. I'm telling you, anything is better than nothing. It adds up over time. Now, we still have the fear that the stock market could go down. You don't want to invest at the top, right? But remember, that's why you are dollar cost averaging in. And here's what may be going through your head. So right now, if you're earning 4% or 5% interest on cash, then you may think better safe than sorry. So I understand that a guaranteed 4 or 5% return sounds safe and that sounds very stress-free. I mean, how much could you really be missing out on, right? Well, let me show you. Once the Fed starts cutting interest rates, that's known as the Fed pivot. So the Fed is pivoting their monetary policy. So the Fed started their pivot on September 18th of 2024. They cut interest rates from 5.5% to 5.0%, and they will continue to cut rates. So from the day of the pivots, here's the historical performance of the S&P 500. So look at the 1-year average return, 13%. The median return is 16%. Now, if you're making 5% interest on your cash, and if the stock market goes up by 13%, then the difference is, of course, 8%. And you might say losing a potential 8% is acceptable because being in cash is safer. So listen, I get it. The stock market can go down. It's evident in the data, but look at the results over time. So look at the performance after 3 years, 43% average return, median return of 41%. And take a look for yourself. It's mostly green. And look at some of those returns after 3 years, 68%, 86%, 114%, 119%. And after 5 years, all right, look at the average return, 89%, median return, 97%. How much interest income will you have earned 5 years from now if you just left it in cash? So I calculated it, it's probably going to be around 20% in total, which is pre-tax. Okay, so what's the lesson here? Over time, the stock market just goes up. Buy and hold. It's so simple once you understand what's going on here. So I'll explain it to you like this. What was the median price of a home in the US 30 years ago? It was $130,000. What was the median price of a home 50 years ago? It was $36,000. So do you think median US home prices are ever going back down to $130,000 or $36,000? So no. It's because of financial asset inflation. The game is rigged. But some people might get clever and say, Brian, some homes and some areas lose value or go to zero. Now, you're wrong, Brian. My response is that's why when you're investing in the stock market, you should buy an index fund or an ETF, because that's like buying a little bit of everything. To make your life easier, I would say buy an ETF. And I would buy an ETF that tracks the S&P 500. So some good examples are SPY or VOO. In addition, I would buy an equal weighted S&P 500 ETF. An example is RSP. So the action plan is very straightforward. Dollar cost average into the stock market, buy an ETF that tracks the S&P 500, hold it for at least a few years, and just set it and forget it. So I understand that it's uncomfortable getting your money in the stock market at record high levels, but that is why you dollar cost average in over time. And when interest rates go down and your cash is just sitting there losing to inflation, you and millions of other people are going to be forced to deploy into equities. Please subscribe. Thank you for the support and wish you a very nice day. Take care.